It's a great pleasure for us to be with you. I'm Bobby Coates, a professor in the Department of Agricultural Economics and Agribusiness in the University of Arkansas Systems Division of Agriculture. In today's webinar, Kristine Tidgren on the impact of the Tax Cuts and Jobs Act on agriculture. Kristine is an attorney and the director for the Center for Agricultural Law and Taxation at Iowa State University. Kristine's work focuses on studying and interpreting laws impacting the agricultural industry with a specific focus on agricultural taxation. Now, Kristine Tidgren on the impact of the Tax Cuts and Jobs Act on agriculture. Kristine, we look forward to your presentation.
Thanks, Bobby, and just thanks to Mary for everybody organizing this. I'm just so excited to be on this webinar with all of you. It's just a great privilege to come to you from Iowa, but we have a very important topic to talk about today, and I'm excited to just walk through it with you and to kind of give you an overview of some of the important impacts of this new tax legislation that was passed last December. Here's my contact information. I do come to you from the Center for Agricultural Law and Taxation up at Iowa State in Ames. And so we have a website that's available for you to go out and research various topics. Most of what I'm talking about today, we have resources available online that go into more detail about these topics. So we'd love to hear from you via email as well. Also, I've referenced our Twitter account there. We try to keep you posted with updates as they come along with important agricultural law and tax topics as well. So with that said, we have a lot to cover in the short period of time that we have. So we're going to just dig right in and get right to it. So back in December of 2017, the largest changes to the tax code since 1986 were passed. And this has caused some clients to be a little bit uncertain, some producers to not exactly know what that means for their situation. But generally, I will say that the new law should result in lower tax liability for most people. And that's not for everybody, but as a whole, you'll see the changes we'll walk through. As a whole, there should be, at least a modest decrease in tax liability for 2018. Now there's some warnings that we're going to go through with some of the provisions that were passed, and there's also some opportunities. So we're going to kind of walk through those and look at what changes might need to be made to the business. Where are there still some unknowns? Where are there opportunities to sort of take advantage of some tax breaks that have been given? So with that said, I want to just start with the first warning, or the first important thing to note, is that most of the individual changes that were made possible by the Tax Cuts and Jobs Act are just temporary. What that means is they are set to expire after 2025. So from 2018 through 2025, one of the changes of the new law was to lower tax rates really across the board. I'm giving you their chart that shows the single tax rates. The tax rates for married filing jointly have also, for the most part, been lowered. And you can kind of look at the differences there. You can see that the top rate is no longer 39.6%, it's 37%. Now, individual tax rates, of course, apply to anyone who is not a C corporation. So if you operate your business as a sole proprietorship, as an LLC, taxed as an S corporation, or as a partnership, then all of these individual tax rates are going to apply to you. C corporations have a different new rate system, and we'll look at that later. Another change that was made on the individual side that really does impact people who are filing tax returns for 2018 is that the standard deduction was essentially doubled. Now, what that means is that fewer people will be liable to even file a tax return, because if your if your taxable income does not exceed the new standard deduction, you don't even need to file a return. And so for 2018, the new standard deduction is $12,000 for singles and $24,000 for married filing jointly. Now that's a pretty big jump. Like I said, it's almost double what it was in 2017. What that will do is significantly decrease the number of people that will itemize deductions. So if you have in the past filed a Schedule a Schedule A to itemize your deductions, many of you will no longer do that. And there's another reason too, is that many of those itemized deductions that we've had in the past have gone away. And so now we don't have the opportunity to itemize as many deductions as we did either in the past. And so we'll talk about that. Again, the increase in the standard deduction is only through 2025. And after that, it will be set to revert back to the way it was before. Now, to help pay for the fact that we now have a increased standard deduction, the new act also suspends what we call the personal exemption. Now, last year, when you filed your tax return, your personal exemption was $4,050 for each person in your family. So if you were married, you had a spouse, you had children, each person got a deduction of $4,050. That's called the personal exemption. That's suspended. So in some cases, that offsets the benefit of the increased standard deduction. And we'll take a look at another way that Congress chose to try to offset the impact of that for people who have children. But I mentioned that not only will fewer people itemize because now the standard deduction is so much higher, but also many itemized deductions have been suspended. So beginning in 2018, we can no longer itemize or take a deduction for what we used to call the miscellaneous itemized deductions that were subject to the 2% floor. And so these include things like unreimbursed employee expenses. If I'm an employee and historically I drive a lot in my business and I get reimbursed from my employer a certain mileage rate, I've always been able to go ahead and deduct on my Schedule EA the difference between what the IRS allows as a deduction and what my employer reimburses me for. Now, if you're in a business like in the agricultural industry, if you do trucking or something like that, that can result in some really significant deductions that will no longer be allowed on Schedule A. In some cases, maybe $30,000, $40,000. So we'll kind of look at what you can do to offset that impact, but that is a significant impact for some taxpayers. Also, smaller things like the cost to prepare your tax return, safety deposit box rentals. If you run a hobby farm, if it's not really a trade or business, if you're not really in it to make money, maybe you have some horses. In the past, you've been able to still deduct some of those expenses on your Schedule A, and those expenses are no longer able to be deducted. So again, the itemized deduction subject to the 2% floor, suspended through 2025. Now, as I mentioned, some employees have been particularly hit hard by this if they've been used to writing off deductions on their Schedule A. And some of those include truckers, maybe some salespeople, or employees that have a home office. And so if you're an employer or you're an employee who is dealing with this, you might want to talk to your employer about setting up an accountable plan. It's a good time to sort of look at different reimbursement plans that are available that might be a better option for you in your situation. One of the changes too that was made to a deduction that individual taxpayers can take is a cap on the amount of state and local taxes that can be deducted. Now, in the past, you could take an unlimited deduction for any state and local property or income taxes that you paid. And depending on what state you live in, this can be a significant amount of money. The new law didn't eliminate the deduction. What it did is it set a cap of $10,000. So you can now only deduct on Schedule A up to $10,000 for these taxes. Now, for agricultural producers, one of the key things to keep in mind is that if you're incurring property taxes for your farm property, for your business property, you still get to fully deduct those amounts on your Schedule F. If you own farm ground and you rent it out, something like that, you get to fully continue to deduct those costs on your Schedule E. This would be for your home property, for your property that you use for personal purposes, but it is also for your individual income tax that you pay to your state as well. And if you don't pay income tax and you have the option to pay the sales tax, to take a deduction for your sales tax instead, it applies to that deduction. So again, a cap of $10,000 for that itemized deduction. So you see, with the fewer deductions that are now allowed, in addition to the doubling of the standard deduction, there's going to be very few people that itemize deductions. Now, one of the ways that that might change your tax situation is, in the past, if you've given a charitable contribution to different charities, to your church, something like that, you have taken that charitable deduction on Schedule A. That's an itemized deduction. If you don't itemize deductions, you don't get a benefit from making a charitable contribution. So for agricultural producers, I just want to point out two ways that you can still get a tax benefit from giving away money or property to a charity. You just have to do it a little bit differently. And one of those ways is the PATH Act back in 2015 permanently allows people who are 70 and a half and older to make qualified charitable distributions from their IRAs. And what that does is you can just make the distribution directly to the charity. It doesn't hit your income. You don't have to pay income tax on it because you never have to report the income from that distribution. So that's one way that you're not depending on a charitable deduction in order to get a tax benefit. Another way for farmers that they can get a tax benefit from their contributions is sometimes you may be able to give a gift of grain or a gift of contribution of commodities to the charity directly. And so you have to make sure that all the I's are dotted and the T's are crossed. But if you handle that properly, what that does is it transfers title of that commodity to the charity, and then they get to sell it when they wish to sell it. You don't recognize the income from that sale. And so that's just another way that perhaps you can get a tax benefit from a charitable contribution, since you may not be itemizing deductions. Now, I mentioned with the loss of the personal exemption, that $4,050 deduction that we had for every person in our family, some taxpayers will wonder what happens with larger families or families with children. Congress made significant changes in this area, and what they did is they significantly increased the child tax credit. So first of all, if you have a child who is under 17 years old, the child tax credit used to be $1,000 per child. Now, just to make sure that everyone understands, a tax credit is a dollar for dollar offset of your actual tax liability. So it's a lot more powerful than just a deduction, which just lowers the income subject to the income tax. And so this is a very significant credit. What Congress did is double that credit to $2,000, and that goes through 2025. And even perhaps more significantly, and I'll point with my little mouse pointer here, is the fact that many more people will be eligible to take the credit, because the credit used to phase out when a married filing joint couple had income of $110,000 or more. But the new law says that phase out doesn't occur until your income hits $400,000. So many more families will be eligible for the child tax credit come 2018. Now remember, this credit only applies to children who are under 17. So I always like to say, when the kids get expensive, right? When they need a car, when they need a prom dress, or they need, they care about what they wear, those types of things, you're thinking about college, the child tax credit goes away. So what Congress did in its place was to create a new credit. It's called a dependent credit. And if you have a child who's perhaps still a dependent, so maybe they're in college, but 17 and older, you get a $500 non-refundable credit for each of those children. And so this is not refundable, but it is a significant tax benefit for those older kids. The child tax credit, the $2,000 credit, it's important to note that that credit is refundable in an amount up to $1,400. And $1,400 can be refunded or paid out to the taxpayer in excess of their actual tax liability. So again, this is a very significant change that was made, a very powerful credit given to families with children under the new Tax Act. Now, those of you who operate your business and have employees or have clients that you like to take out to dinner or take for some entertainment as you discuss business, there have been some changes made for meals and entertainment that are important to point out as well. So what the Tax Cuts and Jobs Act did is it said no more can a business take a deduction for entertainment expenses. So prior to 2018, if you took a client or a potential client out to a basketball game, let's say, and you were discussing some potential business, you could write off 50% of the cost of that activity. The new law says no more entertainment expenses are deductible. And there was a big question about what about the meals that are associated with those activities? What if I have a potential client or a client and I take them out to dinner to discuss business? Is that entertainment? Is that still allowed? And thankfully, we just got some guidance last week in a notice from IRS that says, yes, you can continue to deduct 50% of the cost of meals in that context, as long as you get an invoice that is separate from the actual entertainment event itself. So the example, one of the examples they gave was, I take a potential client to a basketball game. I don't get to deduct the cost of the tickets, but I can deduct the cost of the hot dogs and the sodas that I purchased while I'm there, as long as I get a separate invoice for the cost of that food. So that was a pretty good benefit. What I would like to point out is that in agriculture, there was a significant change that will impact quite a few employers, and that is with meals for the convenience of employers. Now, the context of this is I have employees on my job site. I have them in my fields, and I don't want them to disperse for lunch and be gone for 2 hours. You know, the nearest lunch place is far away. I want to keep them on my site. So because of that, I provide the meal for them. And in the past, I was able to deduct 100% of the cost of those meals as long as they were for the convenience of me as the employer. No longer. Now, beginning in 2018 through 2025, I can only deduct 50% of the cost of that meal. Even more significantly to think about down the road, and perhaps talk to your lawmakers if this is impacting you significantly, is the meals for the convenience of employer deduction is scheduled to go to zero come 2026. So that is a change that will impact some agricultural employers. Now, every time we have a change to the tax code or a significant change that looks at taxes, the estate tax always comes up, the gift and estate tax. And so what the Tax Cuts and Jobs Act did is it did modify some areas of the estate tax, but it left many others intact. And again, these changes are only temporary. They were only made through 2025. And I should note from the onset, really, with everything we talk about, right? Any tax law is truly not permanent, right? Because it's only until Congress changes its mind anyway. But some of these laws are actually set to sunset right in the act. And if Congress doesn't renew them, they will expire. Whereas others, of course, are just meant to be permanent. But the estate tax changes were with respect to how much property, how much money can you own at your death and not owe any estate tax. And that's called the basic exclusion amount. And in 2018, the basic exclusion amount was in the statute supposed to be $5 million per person. And then that was indexed for inflation, so the actual amount was a little higher than that. What the Tax Cuts and Jobs Act did is it doubled the basic exclusion amount per person. And then with the increase in adjustment for inflation in 2018, that means that every person can die with $11.18 million of assets and not have any estate and gift tax liability. So that's a significant change there. It does mean that many fewer people will be liable for estate tax during the time this increased basic exclusion amount is in effect. The Act retains the $15,000 annual exclusion. That means you can continue to give $15,000 away each year to as many different people as you want and not ever even have to file a Form 709, which is a gift tax return. Also, the law retained portability, which is that great provision that allows spouses to essentially share the basic exclusion. So what happens is when spouse one dies, whatever they did not need as their basic exclusion gets ported over. It's called the deceased spouse unused exclusion, and that gets ported over to the surviving spouse. But the only way that happens is if you file a Form 706 estate tax return. So there's something that has to happen at the first death to make sure that that portability happens. But if it's done correctly, it means that spouses together can die with $22.4 million of assets essentially in 2018 and not owe any estate tax. Also, the basis adjustment was retained. And this is a really big deal in agriculture because much agriculture is so dependent on the land, and so many people own property that has a basis that's fairly low, right? The cost at which they acquired the land is fairly low, which means that if they turn around and they sell the land at current values, they would owe a lot of capital gains tax. Now, if you die, the law has for a long time had a basis adjustment provision, which we often call the step up in basis, which means that whatever the value of the property is at your death, your heirs take the property at that value. And we call it a step up in basis, but sometimes it's a step down, right? So if at your death, the fair market value of your property is less than it was when you purchased it, then the value of the basis is adjusted downward. But most of the time it's a step up, and it's something that a lot of people see as a good tax benefit that was retained by the Tax Cuts and Jobs Act. And again, like I said, the basic exclusion amounts are scheduled to reset to the pre-Tax Cuts and Jobs Act levels come 2026 if Congress does not change anything. Now let's get a little bit of context about what this means. So just for giving you numbers, in 2016, there were 5,219 estate tax returns filed for taxable estates across the country. So really, there haven't been that many people each year that have had enough money or property at their death to have to file an estate tax return to pay estate tax. But now that number will decrease even much more. So the estimates are perhaps around 1,800 estate tax returns will need to be filed for taxable estates, meaning that people will owe estate tax at their death. Now, one thing that is really important to stress is that this does not mean that people no longer need to do estate planning. I think that the need for estate planning today is as great as ever. We get stories here all the time from family members who are in battles because proper transition planning was not done during lifetime. And so we just have a lot of issues that arise because of that. Also, another need to plan for is for disability. So, you know, it's the fact that the basic exclusion amount has increased in no way means that estate tax planning is no longer needed. Estate planning is very important. Another thing that it means is that there might be some opportunities during this time when we have a really high basic exclusion amount, as we get a little bit closer to sunset, or if it looks like Congress is going to change its mind and sort of roll back some changes, there might be some opportunities to sort of lock in this higher basic exclusion amount depending on what happens. So we just all need to kind of stay posted. It also means that that portability benefit that I told you about, where spouses can share the basic exclusion amount, might become even more important right now, because you can lock in that high deceased spouse unused exclusion. And even if the estate tax basic exclusion decreases in the future, it's likely that that higher exclusion that the spouse ported over could still be used. So those are just some issues that we're looking at, that we're considering, and that your tax advisors and your estate tax planners can kind of work with you as you think about the future. So those are the main individual provisions I wanted to talk to you about today, the things that really are reported right on the schedule on the Form 1040, right? And what's changed with the Schedule A. But really the big significant changes for most people who have business income, have to do with some other provisions that were passed. And so that's where I want to turn our focus now. Now, we have a number of C corporations out there in the agricultural world. And so one of the largest changes made by the Tax Cuts and Jobs Act was to permanently lower the maximum corporate tax rate from 35% to 21%. And that's beginning this year. And so that, the overall tax bill over a 10-year period costs taxpayers $1.5 trillion. And that's essentially the cost of the lowering of this maximum corporate tax rate. So this is a very significant change that was made. But again, this particular change only applies to C corporations. And overwhelmingly, most of our agricultural businesses are not C corporations, although we do have some. And so those that we do have, I want to point out, this was not a rate cut for everybody. And so if you have a C corporation and you're an agricultural business and you have kept your income historically low, you actually could see a tax increase under the new law, because the old law, even though the top rate was 35%, it was a graduated tax rate structure. And so it started off with your income up to $50,000, you were only taxed at a rate of 15%. The new law says zero up, it's 21%. It's a flat rate. So if you're in that situation where you have a C Corp and your income is typically below, let's say, $80,000, it's a really important thing for you to discuss with your tax advisor to figure out if there may be another option for you. Perhaps it's time to convert to an S Corp, maybe not. One thing about conversions to an S Corp, we often worry about the big tax, the built-in gains tax, because we have a look-back period under the federal system of 5 years. And after you've converted from a C Corp to an S Corp, during that 5-year period, if you sell property that has built-in gains, you have to pay tax on that. That's the equivalent of the highest corporate tax rate. Well, of course, in 2017, that was 35%. So that was a really big tax, and that's what we've always called it, the big tax, the built-in gains tax. 2018, the big tax isn't quite so big anymore because it's 21%. It's the top corporate tax rate. So again, just something to consider, things to talk through with your tax advisors. Like I said, most of our agricultural producers are not C Corps. Most of them are pass-throughs. They're partnerships, sole proprietorships. Perhaps you have an S corporation. So you have an LLC, but most LLCs are taxed as partnerships. If you're in a pass-through structure, the lowering of the corporate tax rate doesn't help you at all, right? So Congress had to try to figure out, how do we help the majority of our business constituents. What can we do for those who are in pass-through businesses? And this was a very complicated solution to try to come up with something, because these producers are obviously taxed on individual tax returns. They all have different income situations, so you can't just give them a simple new rate, right? So what they came up with was a deduction. And so you've likely heard it's called the new 199A deduction. And what it is designed to do is to allow you to take a 20% deduction against your taxable income for the business income that you generate, right? So it applies to what we call qualified business income. And that is income you receive in a business from your LLC, if you're taxed as a partnership, your S corporation, you get it from your partnership, sole proprietorship. It applies to trusts as well. And agricultural and horticultural cooperatives, we have a whole separate system set up for those. So we'll talk about that, but that was a real big deal this year. And so we'll kind of go through the provisions that are in place now for agricultural and horticultural cooperatives. But what the new 199A deduction is intended to do is to lower the effective tax rate for pass-through businesses. So essentially, if you're in the highest tax bracket of 37%, with the 20% deduction, if you got to take that against all of your business income, that income would effectively be taxed at a 29.6% rate. So it's sort of meant to even the playing field, so to speak, for those businesses. Now, the corporate tax rate was lowered permanently under the tax law. It's not set to sunset. The new 199A deduction is right now scheduled to sunset come 2026. So part of the interesting thing about this provision is it's quite complex, and we're kind of joke that just as soon as we sort of get it all figured out, it's scheduled to go away. So it's possible that Congress could extend it. It's possible that Congress could change composition and sort of roll back a lot of these provisions. So there is some uncertainty anytime we're dealing with tax legislation. But I'm going to explain to you how this 199A deduction works, just sort of keeping it in the simplest terms. And so the place you have to start is the deduction only applies to qualified business income. And that's defined as the net amount of qualified items of income, gain, deduction, and loss with respect to any qualified trade or business. And I say those terms very specifically and kind of emphasizing them because they're terms of art, right? Qualified trade or business has meaning, and it has a pretty significant meaning that we will talk about in a minute. But what QBI is, what we have the nickname QBI for qualified business income. It doesn't include wages, so you don't get to take this deduction against money that you earn as an employee. You don't get to take it for reasonable compensation as an S corporation shareholder. So the payments that you get, guaranteed payments you get as a partner in a partnership, you don't get a deduction for that. It doesn't apply to interest income, annuity income, dividend income, or capital gain. And it also doesn't include any 1231 gain or loss that's taxed using capital gains rates. So that's a pretty significant exclusion, right? If you sell a big chunk of farmland and you owe 1231 gain, you have 1231 gain on that, you owe tax on that, you will not get to take the QBI deduction or the 199A deduction against that income. The other significant thing that has a lot of uncertainty is the fact that the income has to be earned in a trade or business. And as I mentioned, that is a term of art, and we don't have a really good definition of that. Even though you'd think, oh, well, that should be pretty straightforward. Is it a trade or business, or is it not, right? Where we have the most uncertainty with respect to whether something is a trade or business is with respect to rental income, right? So if I own property and I rent it out to somebody, is that a trade or business, or is that a personal investment? If it's considered just an investment, then I don't get the 199A deduction. If it's considered a trade or business, I get the deduction against my rental income. And this is where we got IRS guidance in August. We got regulations, proposed regulations that came out then. And IRS said, okay, well, we're going to use the IRC section 162 definition of what is a trade or business. And that's what we're going to use. And so a lot of tax professionals are kind of reeling a little bit because there is no concrete definition of what a 162 trade or business is. By definition, courts make these determinations on a case-by-case basis after a highly factual inquiry, right? So we have one exception for that lack of clarity, and that has to do with self-rentals. So if you own an agricultural business and you're farming, but you own the property in your individual right, and you rent your property to your agricultural business, what the regulations did is said, okay, if rental of tangible or intangible property is being rented to a related trade or business that's commonly controlled, meaning 50% or more of the owners are the same, then we're going to automatically consider that to be a trade or business, and you will get to take the deduction. So that is a really helpful bit of clarity, because in the agricultural context, a lot of times we're dealing with parents, grandparents, and children renting property to the farming operation, and all of those people, parents, grandparents, children, are considered, if I'm the parent and I'm renting it to my child, we're going to be considered to be commonly controlled. We're going to be considered to be the same person in that context. So that's one area that IRS provided clarity. Where they didn't provide clarity was with rentals to unrelated parties, right? So I cash rent my farm ground. Is that a trade or business? Likely, maybe not. If I crop share my farm ground, maybe, maybe not. Again, the key definition we have from the Supreme Court is to be engaged in a trade or business. The taxpayer has to be involved in the activity with continuity and regularity. A sporadic activity, a hobby, an amusement, or diversion will not qualify. Well, that may mean different things to different people. And like I said, you're going to have to look at the facts of each case. How much time are you spending on the management of your rental properties? Are you spending a lot of time finding new tenants? Are you spending lots of time with your tenants? Are you investing a lot of money maintaining your property? Those types of things are all factors that would be looked at by a court. And so we just don't know right now when farm lease income would be qualified business income allowed for the deduction. And so we're hoping perhaps when IRS issues their final regulations, they'll give us a little more clarity. But right now, what we do know, right, if you have a materially participating lease, let's say you have a crop share arrangement where you're required to materially participate in the farming operation, yeah, then you're in the trade or business of farming, and you definitely will have QBI income. If you have CRP income, we have some case law that supports the fact that if you are having some management activity in that, doing the seeding, that type of thing, that you're in a trade or business, and that's QBI income. Other crop share cash rents, you know, basically it looks like you have to have some activity other than just collecting the check. But right now we just have a lot of questions about that. So we really have to wait for some more IRS guidance before we sort of know if we need to change our leases or how we need to structure things to try to take advantage of this new deduction. Now, one thing that's really important to understand, once you know that you have qualified business income and that you're eligible for the deduction, income is really important. And that's because there are some limitations that will come into play once your income goes above certain dollar thresholds. But if your income is below $315,000 for married filing joint couples, or $157,500 for singles, then the calculation is really quite simple. The deduction is the lesser of 20% of your qualified business income, or 20% of your taxable income minus your net capital gain. So you're not going to get to count your capital gain in your taxable income. So again, that could count against people if they have a large capital gain in a particular year. You may not get much of a QBI deduction. But it also means that income thresholds are key, and you might need to do some income tax planning, income management, keep your income below the threshold in order to make sure that you are eligible for the deduction. Because we have those income thresholds, and then once you're above the threshold, if you're married filing jointly, there's a $100,000 range where whatever limitations apply are phased in. If you're single, there's a $50,000 phase-in range. And so any limitations, and there's two main ones, there's two limitations I'm going to tell you about. Those are fully phased in when your income is above, for singles, $207,500 or above $415,000 for married filing jointly. So let's look at what those limitations are, right? But before we do that, I'm going to give you a straightforward example of a producer who is under the income threshold, and I'm going to show you how it's a fairly straightforward calculation. So we have James, and he's single, and he has taxable income of $100,000. And his taxable income includes $44,000 in wages because he has an off-farm job. He has $68,000 in qualified business income from his farming operation. And then he gets to take the $12,000 standard deduction because he's single. In James's case, his 199A deduction is going to be the lesser of 20% of $68,000, which is his qualified business income, or 20% of his taxable income minus capital gain. In his case, he doesn't have any capital gain income. His 20% income is higher than his actual 20% of his QBI. So James gets to take, in this example, a $13,600 deduction. And so his taxable income is going to decrease from $100,000 to $86,400. And so right there in 2018, as compared to what he would have had in 2017, he's going to be taxed on less income. But then that part two for James is, remember, the tax table that he's going to compare that income against is going to have lower tax rates for the most part. And so he will have, in James's example, lower tax liability in 2018 than he did in 2017. That's for somebody that has no, that's income falls below those thresholds. If your income falls above the thresholds, you have to wonder if you are in a specified service, trade, or business. Because what Congress did is they put in this special limitation for certain categories of businesses. And it doesn't apply to a lot of agricultural businesses, but it could apply to a few. And it also applies to people who are in the business of helping you with your taxes and things, right? So specified service, trades, or businesses include any health professions. Veterinarians are specified service, trades, or businesses. Lawyers, accountants, actuaries. There's a category there, financial services, brokerage services, and then there's kind of a category called consulting services. So it's possible that could include, maybe some crop scouting, that type of thing. And if that's the type of business that you have, if your income is above the threshold, then you will not get to take, if it's above the phase-in range, you won't get to take the QBI deduction at all. If your income is within the phase-in range, you'll only get to take it if you have what we call W-2 wages, and we're going to look at that in a minute, but it's basically going to be phased out fairly quickly. And if your income is below the threshold, you don't have to worry about the specified service, trade, or business limitation. So that's limitation 1 when it comes to the QBI deduction. And again, that's not the one we have to worry about so much in the agricultural context. The limitation that will come up for anyone in agriculture that has income above the threshold is the W-2 wages / property limitation. And again, if your income is below the threshold, this limitation does not apply at all. If your income is $50,000 above the threshold, within that $50,000 range for singles, or within the $100,000 range for married filing jointly, it's phased in, which means even if you don't pay W-2 wages, you'll get to take some of a 199A deduction. If your income is above the threshold and the phase-in range, which the numbers there on your screen, $207,500 for singles and $415,000 for married filing jointly. If your income is above that, then it's fully implemented, which means the only way that you get to take a 199 deduction at all is if the deduction you have to look at the W-2 wages or the depreciable property that you own in your business. And it limits your QBI deduction to the greater of 50% of those wages or 25% of your wages plus 2% of the unadjusted basis of qualified property immediately after acquisition. So I'm smiling because that's a mouthful. We call it UBIA. And we're not going to go into the weeds on all of this, but I just want you to understand if your farming income is above the phase-in range, then you have to have employees that you pay money to, or you have to have depreciable property that you can count under these 2 tests in order to take this new deduction. And so W-2 wages are just like the wages that we had. It's just like the limitation we had under the old DPAD, if you were familiar with DPAD, in terms of you have to have it in box 1, box 5. It's a system where it actually has to be something you've paid out to employees. In the agricultural context, if you pay commodity wages to employees, if you pay your employees, let's say with a cow or by giving them grain or wheat or something like that, that's not going to count as wages. So it's not going to help you if you are trying to be able to take the deduction if your income is above the threshold. And there's also another one in the agricultural context where if you employ your own children under 18 for agricultural labor, it's not considered employment, so it's not considered wages for purposes of this limitation. Also, when we're talking about being able to count your depreciable property, what does that mean? It means that you get to count the unadjusted basis, what you paid for the property essentially. And without going into too much detail, you get to take the cost of your property and you get to include that amount as your UBIA for at least 10 years. Even if the depreciable life of the property, the maker's life is 7 years, you still get to count it for 10. And if it's more than 10 years, the maker's life, you get to count it for however long that life is. So again, that's a fairly complicated prong of that limitation, but I just want you to know that it exists, and it's something you need to discuss with a tax advisor. You need to get with a tax advisor if you have income that goes above those threshold amounts, because there's probably some planning that needs to be done to maximize. Another planning tool for you if your income is above the threshold is that you can aggregate separate trades or businesses to increase your deduction, because let's say I operate 2 separate trades or businesses that are related, and as long as they meet the tests that are in the proposed regulations, you get to count the wages that you might pay in one business across both businesses, thereby getting a higher QBI deduction. So again, aggregation is a tool that you can talk about with your tax advisor if you have income that goes above the threshold and you have to worry about those limitations to the 20% deduction. So that's enough of the basics of the 199A deduction. I next want to turn to the cooperative provisions, the provisions that deal with farmers or producers doing business with agricultural cooperatives, because this has been quite a journey. And it kind of starts with one of the significant changes that the Tax Cuts and Jobs Act made was to repeal the 199 deduction. The 199 deduction was the DPAD deduction, right? And that was that 9% deduction that we had for products that were produced in the United States. So it applied to manufacturers, it applied to agriculture. It had limitations. It had a W-2 wages limitation. It had a W-2 wages limitation that started with your first dollar that you earned. So, you know, it was a limitation that was actually helped if you sold your grain to a cooperative. The cooperative could calculate the DPAD deduction at its level, and then it could pass it through to its patrons. And then the patron, even if they didn't have wages, they could still take the DPAD deduction. So that was a benefit a lot of cooperatives found with DPAD. And so there was a lot of concern when DPAD was eliminated for cooperatives as far as would this new tax law be beneficial for them or would it hurt them? And so at the last minute, we had a provision that went into effect last year that really would have caused a lot of market distortion. And what it was is it said that qualified cooperative dividends could take their own separate 20% deduction, and you wouldn't have to go through the calculation that we have for 199A where we're using net business income. And what was not, I think, clearly understood by all the members of Congress when they passed the law was that if you market your grain, for example, through a cooperative, you get paid for your proceeds of that sale, but that's considered what we call per unit retains paid in money, which fell within the definition of what a qualified cooperative dividend is. And so the law, as it was passed last year, would have made it so that many sales by farmers or patrons of cooperatives to cooperatives could make their sale tax-free, essentially, in many cases, because they were going to get to take a 20% deduction against their gross income from the sale. And that caused a lot of concern because on the left side of your screen here, you see the difference. If you sold it to a non-cooperative, you would get to take the 199A deduction, as I just explained to you how it works, which of course is taken against your net business income and then limited by 20% of your taxable income minus capital gain. The qualified cooperative dividend, as originally written, had none of those limitations. And so again, it went back to Congress, and this is the picture that kind of explains, I think, how law is made sometimes, tax law. Any kind of law getting made, you probably don't want to watch it get made because it can get kind of ugly kind of fast in terms of, you know, everybody has the provision that they want, and then everybody kind of goes in a room and tries to hammer it out. And what comes out in the end may not be necessarily the best thing, but it's something that works best for everyone. And so what happened is when it became evident that the original qualified cooperative dividend provision was going to have a market distortion effect, Congress actually reconvened in March of 2018 and passed a new provision within the omnibus bill, the Consolidated Appropriations Act, to fix it. And so they significantly changed how income received from cooperatives and income received by cooperatives, how 199A applies to that income. And so I'm just going to give you an overview of how that provision works so that you can kind of understand it. And again, with the caveat that this may not have been what people would have initially come up with had we been starting with a blank slate. But remember, we were coming at it from the back end of trying to fix something that just didn't quite work. And so now what happens if I'm a patron and I'm selling to a cooperative, I'm going to calculate my 199A QBI deduction exactly like I just explained to you before. I'm going to take 20% of my net income from the sale of that commodity, and that's going to be my starting place for my QBI deduction. But then I'm going to have to make a subtraction, and that subtraction is going to be 9% of any net income attributable to a co-op sale, or 50% of the W-2 wages I pay out attributable to that sale. And I only have to subtract the amount that's the lesser of those two. So if you're following me, what that means is if I'm a producer that doesn't have any employees, if I don't pay W-2 wages, I don't have to make a subtraction. So I'm going to get to take my 20% QBI deduction. If I pay wages, my deduction is going to get reduced. So if my wages are enough, I'm going to have to take away 9% of my QBI deduction and be left with an 11% deduction. And so that's my starting point. And then what the law did is it basically sort of reintroduced DPAD, but only for agricultural and horticultural cooperatives. And it said, okay, you're going to get to take a deduction equal to up to 9% of your QPAI, your qualified production activities income, just like the old DPAD, and it's limited by 50% of the W-2 wages that the co-op pays. And so then the co-op is going to have this 9% deduction that they get to choose. Am I going to keep the deduction, or are we going to pass it through to our patrons? And if they pass it through to their patrons, then their patrons are going to get to add that pass-through amount to whatever the regular QBI deduction is that they calculated, meaning that if I'm a farmer that didn't pay any wages, I might end up with a 199A deduction that's higher than 20%. In this little example I have here, where the co-op passed through the deduction, this farmer that doesn't pay wages ended up with a 25% QBI deduction. If I have a farmer that pays wages and had to reduce the QBI deduction by the 9%, but then the co-op passes through the new DPAD deduction, then I might end up, for example, in this example, with a 16% QBI deduction. But we just don't know. And that's why I call this sort of the Forrest Gump provision. Because what it means is that if you sell to a cooperative, you're not sure when you sell to the cooperative, maybe you'll get a higher deduction selling to the cooperative, or maybe you'll get a lower deduction. But either way, you're not really going to know up front what you're going to end up with. And that was really the intent of the fix, was to make sure that there was no market distortion. And so they did not want the law to influence marketing decisions. And so that's sort of a really big provision in agriculture. I want to just kind of quickly review some other really important things that have been implemented with the new tax bill. And one of those is beginning in 2017, beginning after September 27th, 2017, bonus depreciation was increased from 50% to 100%. We now have 100% bonus depreciation for used and new property for a temporary period of time. After 2018, it begins to phase out over time, but for 2018 through 2022, we have 100% bonus depreciation, and that's a big deal for a lot of farmers. Again, be a little careful when you're writing off massive amounts of equipment that you purchase, because you have to think about the recapture on the back end, right? If you go out of farming or you turn around and sell, then you're going to have to pay income tax on that. So it's just something to be aware of. as we go along. Also, if you're writing off everything and keeping your income very, very low, you also have to think about retirement, right? You know, we always like to think, oh, I want to reduce my self-employment tax, but we don't want to reduce it so that we're not paying any self-employment tax. Section 179, the expensing provision, has also been increased. It was essentially doubled. So in 2018, we have a $1 million Section 179 deduction. Another change was that like-kind exchange treatment or tax deferral treatment is still available for real property. So I can still exchange a bean field for an office building and defer any capital gain that I owed on that sale, and it'll roll over into the basis of the property I acquire. But if I trade a combine for a tractor, no longer is that a like-kind exchange. That's going to be a recognition of income. It's treated as a taxable sale and a purchase. And Congress said, well, that's okay because you know, you now have 100% bonus depreciation. You could write it all off. But again, those things are handled just a little bit differently under the tax laws, and you just have to be a little bit careful to make sure you understand. Also, any new farm equipment you purchase in 2018, there's a new class of property now that's 5-year property, not 7. Used property that you purchase is still 7-year property. Net operating losses are treated differently. They've been scaled back a bit. So 5-year, you can no longer go back 5 years with an NOL in farming. You can only go back 2 years. And any net operating loss is limited to 80% of your taxable income for losses that are incurred beginning in 2018. There was a change with the business interest deduction. And what that means is that if you have gross receipts at 25 million or above, your deduction for business interests that you pay is generally limited to 30% of your adjusted gross income. So there's been a number of other changes too, like expanded cash accounting, the suspension or the elimination of the corporate AMT. But I'll just leave you with one point. With all these changes, just know that your tax professionals are probably going to have to charge you more this year. It also means that if you haven't made an appointment with your tax advisor, it's probably time that you get that scheduled to figure out if you should be changing the structure of your business to make sure that you are getting all of the deductions to which you're entitled and that you're handling things properly just to maximize your economic position.